Hey, accounting scholars, welcome back. Well, we've been doing some exciting things here. And you may not realize it, but this type of information, uh, classifying fixed costs, classifying variable costs, classifying mixed costs, and using those to derive changes in total costs are really a foundational principle that's used in accounting and management accounting. It even ties to the concepts that you may have picked up in economics, the concept of marginal cost and marginal revenue, and the law of diminishing returns, all those kinds of good things. So this is very, very exciting because this is stuff that's actually used in business and will certainly give you a head start in your college classes. Okay, so let's kind of do some drills here to see if you can make some determinations in the types of costs that are represented by the data below. So we have 6 data points here where we've captured activity level at various points, and we've captured the total dollar costs that are associated with those. And for the purposes of consistency, we're going to call activity level AL, and we're going to call total dollars or total cost TC. Okay, so looking at the behavior of kind of what's going on here, you see the activity level varies from 35,000 units on up to down to 32,500, and these are in kind of a random order as opposed to a linear order. So they're kind of bouncing all over the lot: 35, 40, 37, 45, 42, 32. Okay, but then let's look at the right column, the total dollars. So even though the number of units produced or activity level is bouncing around, or is jumping around from in the data points, the dollars, the total dollar cost, tends to be uniform. 50 at 35,000 units, 50 at 37,500 units, $50,000 at 32,500 units. So based on what we've talked about, fixed cost, variable cost, mixed cost, what kind of cost do you think this is? Why don't you reflect on that for a second? And I'm sure you've got the answer, but clearly it's a fixed cost. And if you were to some extent to plot those points and plot those costs on a dollars and units graph, you can pretty much see that it would fall into the fixed cost category because there's basically the curve is basically flat. There's really no change over the relevant range. Okay, so that was an example of a fixed cost. Let's take an example or another example. Okay, so we have 6 data points. We look at the activity levels here. Data point number 1, we've got 10,000 units being produced, and you have a $20,000 total cost associated with those units. Then you do 12,000, and now you're up to $24,000. Then you do 15,000, and now you're up to 30,000. And so we've got a couple other random points: 11,000, 13,500, 16,500. And you can see that there seems to be a linear relationship here between the amount of activity that is going on and the total dollar cost associated with that activity. So here again, reflect for a moment and let me know what you think this type of cost representative. Is it a fixed cost? Are these data points, do they represent a fixed cost curve? Do they represent a variable cost curve? Kind of where are they in that schema? Or do they represent represent a mixed cost curve. So take a second, think about it. Okay, I bet you got the right answer here as well. The right answer is a variable cost. As units, if you plotted those points, it would probably look like a graph very similar to this. You know, the variable, it would be in the curve would behave like the variable cost, whereas units increase, the total cost increases. And again, the example here being an iPhone, right? You know, if you were, for every iPhone you make, you're going to increase the total costs of manufacturing, because you have variable costs associated with the individual subcomponents that make up an iPhone: the screen, the case, the processor, the software, etc. Okay, so that's a great example of a variable cost. Let's look at another example of a cost. Okay, here again we have 6 data points. We have activity levels kind of going from 5,000, 6,000, 5,500, 7,500, 8,000, 6,500, and then we have total dollars. Now, if we look at that, there doesn't necessarily seem to be a linear relationship between the activity level and the total dollars, as there was on the previous slide. You know, we got 5,000 and there's 7,000, 17,000 costs. We got 6,000 and there's 20,000. Then we've got 8,000 and there's 26,000. What the heck? That's not linear. So think about, again, you know, when you have this kind of thing where the numbers do not appear, the relationships between activity level and total cost do not appear to be linear, nor do they appear to be fixed. By definition, what kind of costs are we talking about? And here again, reflect on it for a minute, but I'm thinking you probably got the right answer if we were to choose between 3 costs here: fixed, variable, or mixed. And it is very much a mixed or semi-variable cost, right? This could be a situation where, you know, for a certain period of time, you could manufacture a given set of units in one factory, let's say, but when your demand jumps and the activity level jumps, you may have to get another factory. So now you're dealing with semi-variable costs, where you have to add the cost of a second factory, as we talked about earlier. So guys, I think you're getting a good understanding, or hopefully getting a good understanding of the type of costs that we're talking about. In the next section, we're going to talk about how we can use this data to actually predict any one of those 3 variables, either fixed cost or variable cost, to determine total cost. So have a great night, guys, and we will see you tomorrow.